Our first speaker is Andy Virgo of LendInvest, the Director of Buy to Let, and I'm hoping it is now added as a presenter. Excellent. And he should appear on the screen in a moment. And as I mentioned earlier, Andy is a long-time supporter of our roadshows, one of the loveliest guys in the industry as well. And I'm not just saying that because he's a Director of Buy to Let, by the way, because I've known him for many, many years. You should have received by email, there's definitely by email this one, you'll receive this, which is that up-to-date product guide for the changes that took place towards the end of September. And a little bit on Andy, first of all. Joined LendInvest from InterBay Commercial in July 2017 to assist with LendInvest entry into the buy-to-let sector. Previously a BDM within the OSB group. Andy worked as a commercial mortgage broker with Christie Finance and established a property finance brokerage in 2006 after a stint with NatWest Bank in their real estate team. Initially charged with the product development alongside broker management, Andy took on the role of head of key accounts when LendInvest joined forces with the industry's mortgage clubs and networks. After winning the NACFB's Best Buy-to-Let Lender Award in December 2019, Andy was subsequently promoted to Director of Buy-to-Let, thus responsible for the development and subsequent success of LendInvest Buy-to-Let proposition. I've got to say, probably all the launches that I've seen, from, again, it's not me blowing smoke up here, you know what, but of all the launches that I've seen over the years, this was probably one of the best and most seamless. It really was fantastic. It was just a real breath of fresh air once it launched. And it's been great being a supporter of theirs, being there right from the start. Interesting fact on Andy, his is nothing to do with any Radio 1 DJs or anyone with a mullet. His interesting fact might be surprised to learn that Andy once broke his leg in a swimming pool, which I'm now going to get Andy. Andy, can you hear us? And
yes, I can hear you loud and clear.
If you just want to give a quick explanation of that, just whilst I sort out the next slide, because everyone's probably waiting to break a leg in a swimming pool. So over to you.
I was about 6 years old, and my dad had bought me a book of, I think it was I Spy Book of Diving or something like that. Teach yourself to dive. Remember the I Spy books if you're old enough? And it said, sit on the edge of the pool, put your feet on the bar that you normally hold on to when you're swimming, and then lean forward. I leant forward, my head went into the water, my leg went behind the bar. So there I was underwater with my leg trapped behind the bar, broken, and got little photos of me as a 6-year-old in plaster, looking ever so sad and sorry for myself. But yes, my dad waded across the pool and saved me from drowning, and I'm scarred for life. There you go.
There you go. Never put your foot behind the bar at a swimming pool. If you get anything from today, that's a good bit of advice. Andy, over to you. You're ready to go, so I'll see you in about 20 minutes.
Thank you, Tony. And just a great number of insights that Tony's provided there and to the industry. And I'll try and sort of weave some of my own insights into this presentation as we go along. But yes, my name is Andy Virgo, Director of Buy to Let. I am product lead on Buy to Let within LendInvest. Enjoy a few relationships with some great brokers out there, which is where we get our feedback and our intelligence to grow our proposition. So a little bit about ourselves, and I'm going to talk you through LendInvest, the buy-to-let proposition and where we've been this year. So back in 2008, there was an opportunity that came from from the financial crash, and our two owners of our business set up LendInvest as it is now known, but then it was called Montello. Montello was a bridging finance company, a couple of guys in a windowless room with some funding in place trying to lend on bridging loans. Very, very slow to start off with, gathered some pace over the years, started to investigate the peer-to-peer market. Didn't go down that route in the end. Instead, we got people to invest in our business and use their money in a peer-to-peer like way, but we gave them a proper return on their investment. We linked the money to a loan as opposed to them seeing the money linked to a loan. That progressed very well. In 2015, it was decided to bring development finance on board, so that whole let's fund a piece of land that eventually is developed and then properties are sold on. So development was added in 2015. I joined in 2017, and we established the buy-to-let proposition, which we launched 3 years ago next month, and it's going great guns. In terms of the year, let's talk about where we've been, where we are, where we're going. Back in January, February this year, we had a buy-to-let proposition that saw us kind of mid-table amongst our peers. Everything was very much straightforward. Cases were coming in, the volumes were increasing. We had a very good feeling about 2020. In terms of the products that were available, we had loans up to 80% loan to value. We were not worried about getting involved in large deals, so we were lending up to £3 million on property, buy-to-let property. Interest rates were significantly low, 2-year fixes at 2.89, and everything was heading in the right direction. Service was brilliant. You know, we were app received to formal offer was 14 days tops, and we were getting some cases out quicker than that. We wanted to get to a point where we could be known as the lender that could provide a 30-day remortgage. Application in, underwritten, valued, into legals, use title indemnity insurance. We pay for that. Get your mortgage redone in 30 days. So that's where we were back in January, February this year. I went on holiday to Egypt, had a week in the sun. It was the end of February going into March, and I came back to Gatwick, having kind of heard while we were in Egypt about some issues in Italy. You know, some people, you know, some stuff has come across from China, and Italy's going into lockdown, and it was all kind of strange. Got back to the very congested passport control at Gatwick Airport. Noticed a few face masks. Went to the baggage area to collect our bags. Packed, absolutely packed. A few face masks there as well. Got back home within a couple of days. Appointments were being cancelled, and all sorts of things were going on. You know, the shelves were getting raided for toilet rolls and flour. Who would have thought it? The two things you need to survive COVID. So we had some lenders that were not able to securitize, sell their loan books, so they had to close down. We had some that were managing applications by pricing very high or reducing higher loan to value loans, offering just 60-65%. Then the valuers stopped going out. We did reduce loan to values, but we kept lending. We kept receiving applications through that period. We stayed open. Yes, we furloughed most of the business. But a skeleton of the staff kept us afloat, and we were providing buy-to-let mortgage offers subject to the valuation when the valuers came back. We developed a desktop product, so we developed a 1-year fixed rate desktop valuation product called Buy-to-Let Plus, which took a long time to get through our funders, who are American and Australian, so their rules of the legal and regulatory rules are different to us. So we had to do a lot of convincing to get them to accept a desktop valuation for a buy-to-let mortgage. But that was launched at the 12th hour, literally. So within a couple of days of launching that, the valuers started to come back out again. So we are ready for the next total lockdown. And we will be able to carry on completing mortgages and valuations should it come again. So yes, we had a lot of payment deferral inquiries. We're quite a new business, so we weren't struggling like some. Some of my peers I've spoken to, there's one lender had 70,000, another one who closed their doors had 60,000. There's another large lender who we all know have 40,000 applications for payment holidays. We were very lucky in that regard that we weren't bogged down. So where are we now? Well, the whole business is still working from home. The office is closed. I've been here now since before the 23rd of March, struggling with it, to be honest. I'm a people person, love getting out, seeing the countryside in my car and visiting brokers and speaking to different people about different topics. And this whole screen thing is quite a tough thing to cope with full time. The whole business working from home has not done anything to delay how we have provided a seamless service to our brokers and landlords alike. There's been no impact negative on the business. We are full up with money. We have been all the way through this. We've taken a very cautious approach, as we should do, to protect our investors. We have to lend responsibly, and we have to protect landlords against making some silly decisions. I'm glad to see that 85% loan to value mortgages that came out recently have been pulled, because they are not really the direction people should be going, with an impending price crash, house price crash next year, potentially. So it's all about risk. We're monitoring what's going on. We're talking to our broker friends, and we're listening to the feedback, and never before have we been more knowledgeable about what's going on in the economy and how it may affect us. But we're booming. Business is booming. We've got a record number of applications coming in, dips being done, that obviously move into applications. The good thing is that we're getting people coming to us time and time again, having got used to our very, very simple process, which we'll talk about in a second. We're doing more and more and more lending as each week goes by, and we are, I think we've gone from probably being a lender in the top 10 of amongst our peers to a lender in the top 5 amongst our peers. Very, very strong in price, which we'll touch on slightly in a minute, and very, very strong on criteria, and ultimately are a good lender for you to research and work with moving forward. So why are we so busy? Well, it's the stamp duty cut. Obviously, you know, we've gone from having 25% of our applications being purchase of property to the latest 58%. 58% of our applications are for purchases as opposed to remortgages. We haven't seen that. That's not something we've seen before. I have a huge frustration with the press at the moment. So this is one of my industry insights. There's a lot of press that you're probably reading, and I'm reading, that's saying that the stamp duty window is closing in the beginning of November, and people have to get their applications in now or they'll miss out on the stamp duty offer. Well, 31st of March next year is when the stamp duty holiday is supposed to end. It may be continued, we don't know. Watch this space. I don't have any particular insight on that except a few rumours. There's also the Help to Buy finishing 31st of March next year. So yes, solicitors are proper swamped. They're going to be slow. Land registry is going to be slow. So yes, it is absolutely right to get your applications in now. But what are lenders doing about it? Well, we've brought on a third legal firm. We've brought a new legal firm on. We've secured with them and agreed some SLAs that they can get our applications. As soon as they receive their instructions, they'll get completions done in 30 days. So our mortgage offers are available for 90 days. Our average completion timescale is 60 days at the moment. So I don't see any reason why we can't be accepting purchase applications for properties in December, January, and maybe even February if we can expedite some completions. So if you are thinking about talking to your clients about payment stamp duty holiday effectively being void if you don't do anything by 2 weeks' time, that's rubbish, because us lenders are preparing for an influx post-Christmas. We're also offering appetite statements to landlords at the moment. We're trying to encourage people to come back to us. So effectively what we're saying is, if you come to us with an application for a purchase or a remortgage and you have a landlord client that has a desire to buy property, remortgage property over the next year or two, well, why don't we tell them how much we're prepared to lend to them? We're doing the credit search, we're doing the research on them. So while we've got the bonnet up, why don't we have a look and see what else we can fix? So from that point of view, we are providing appetite statements if they're requested, which is a sign, which is effectively a letter that you and the landlord will get, you as the introducing broker and the landlord will get, which says we're prepared to lend you £1, 2, 3, 4, 5 million for you to continue to grow your portfolio of HMOs in the West Midlands. Whatever you tell us your plans are, whatever they decide their plans are, we'll carry out a quick interview with them, and then we'll help them grow their portfolios, and it makes for a nice relationship. Easy to come back to a lender that knows you. So in terms of our product offering, 80% loan to value is back. We're one of 2 lenders, us and Foundation, that are offering this facility. We're both priced the same. The difference is we're at 24-hour turnaround on service and they're at 6 days. Apologies, I have just poo-pooed the competition. But the facts are the facts. And now it's all about not only rate and cost over time, but it's also about service and how quickly you can deliver on these mortgages. We're not back to 2.89. There's no real desire to go into a rate war at the moment. We're all sort of having to pay our rent still for our central London property offices that we're not using. It's very sizable and kitted out for us. And we're developing tech all the time, so we can't afford to be too cheap. We need to make a bit of profit to cover the losses that we've made effectively from payment holidays and reduced business levels for effectively 3 months. We're okay with payment holidays. We're okay with deferrals, payment deferrals, as we now call them. We're okay with bounce back loans. We're okay with all the government loans and that people are taking. We just want to make sure that when we lend to these people, that they are in a good position financially. And, you know, as Tony said, some people took these loans thinking they were just available, not realising the consequences. We're still offering £150 valuation fees on our standard buy-to-let applications, which is pretty good, seeing as we don't have an application fee. And then there's some cashback, which I'm going to talk to you about quickly in a moment. So we've just released in the last couple of weeks some new some changes to our proposition. I won't go through these in too much detail, except to say that we're looking to lend on larger properties with larger £1.5 million loans. We're happy to lend at 75% on new builds. First-time landlords, we can take up to 70% loan to value, and we're okay with studio flats back in London as that's growing as a sector. In terms of the HMO market, we've dropped our fee on our HMO product down to 1.5% for small HMOs, and we're lending to student lets again. Students want to go, we've been waiting to see what students are doing. Students want to go to the experienced student life. A lot of them are realising that it's not a good idea to go to the purpose-built student accommodation where one person gets COVID, everyone gets COVID. So a lot of these slightly out of town, small HMOs, students are in, and we're quite happy lending to those. Multi-unit freehold blocks, we're back up to 75% loan to value. That's 10 units in a block. I mentioned about 80% loan to value. This is a limited edition product. We'll see how it goes. Maximum loan £500,000, remortgage and purchase. It's very vanilla stuff. You know, we're not looking to lend on flats above commercial. It's just standard houses, standard flats. And that's a product that's starting to grow arms and legs for and start to get some good traction. So as I was saying, the types of properties we lend on, standard buy-to-lets means a house, a flat above commercial, a block, flat in a block. HMOs, we have two types of HMOs, small and large. We'll value a small HMO using bricks and mortar, vacant possession. A large HMO, we use investment value. Some people call it commercial valuation, long form. The proper title is Red Book, but it's taken into consideration the value of the business as well as the value of the property. So that's 7 to 10 rooms, our large HMOs, maximum loan £1 million. Multi-unit freehold blocks, as I mentioned, maximum loan £3 million, but again, that's a good asset class to lend on. It's proving quite popular. Rates, won't dwell on these, except to say that the rates are extremely competitive on the sourcing systems. You will find us for limited company borrowing sort of top, next to top amongst our peers. So we're sourcing very well on the sourcing systems. Breaking news, I have a meeting at 3 o'clock this afternoon where I'm going to be requesting that we bring out a new product, a pay rate product for corporate borrowers. So that's limited companies, SPVs, not trading businesses, trading development businesses, yeah, but not trading as in fish and chip shops or funeral directors. So limited company, LLP, SPV, we will lend on a pay rate product. So that's 3.69 stressed, 125 at 3.69. It's not for individuals, just for our biggest borrower class, which is limited companies. It's all about securing leverage. So on an average deal, with our current proposition, where we use 4% as a stress test, a £210,000 property with an average yield would net 67.5% loan to value. So making this change that I will get signed off this afternoon, so I'm confident enough to put it in the presentation, that next week we'll be launching this with a 3.69 pay rate that will see that just sub 3.5% yield property will achieve the loan close to 75% loan to value, which is securing the leverage that the landlord wants. In terms of the process, Tony will manage the process for you on all of our applications. Tony and his team are well versed with how we work because it's very simple. Everything's online. We use e-signatures. We don't ask for proof of ID. We use an app called On Fido, which takes a picture of your passport and then a selfie, a bit like when you come back from holiday and you put your passport in that scanner and you look at the blue whizzy light and it tells you that you're a UK citizen and you can come in. Open banking we are using to get applications in and out very quickly. It allows us to see an up-to-date position on people's credit. We can see that a bounce back loan or a payment holiday has obviously not impacted them negatively. You can't get that information from bank statements. Open banking is great for getting cases in and out very quickly, makes it easier for us and easier for you, because when you're working from home, it's really hard printing off bank statements from your home printer. And of course, we will use everything we can in terms of integration with systems that allows us to automate the process as much as possible. We've got a roadmap to deliver a load of APIs that will allow us to offer credit-backed decisions in principles and all sorts of things coming in the near future. Rattling through the cashback I referred to, if you apply for a 5-year fixed rate loan with us on a standard buy-to-let property, we'll give you £500 cash back to go towards your legal costs. If you then allow us to use open banking or facilitate the use of open banking for us to get the underwrite done quickly to save you doing some work in providing us information, we'll offer £200 cash back. So that's per application. So imagine somebody's got a portfolio of 10 properties. That's £700 cash back per application, times it by 10. I like this slide because it brings to life who we are, where we sit in the market. So these are our peers. These are our friends. These are the guys I talk to frequently. We all get on. It's a great industry to be in. But these are our peers. These are our lenders, and these are the people. If you are working with at the moment, then you need to stop and just think about LendInvest, because there are items within our proposition, pieces within our proposition that prove that we are often a more favourable lender than a lot of these peers. Notice I didn't say competitors. So just to recap, we are very much about leverage. We are very much aiming to become your lender of choice. We're working very hard on everything we do to be as easy to work with as possible. We want to keep it simple, make things simpler. Remember the cashbacks, remember the low valuation fees. And when you are thinking about inquiring about whether your next inquiry could be a loan right for InterBay. InterBay, I used to work there years ago. Chrissy will like me for that one. So LendInvest, it's even written in front of me. I've never done that before. So yeah, contact Tony and his team. They know all about our process. They know all about our sweet spots, what's behind the criteria. They've got a direct line into me to get exceptions made. And as such, we are receiving record numbers of applications from specialist finance at the moment due to these roadshows and workshops and webinars. It's fantastic, and we very much thank them for the invite today to step in. Thank you, Tony. I wish you all the best for the rest of the day, and if anybody has any questions, please feel free to shout.
Thank you, Andy. It says there pretty much any of your documentation needs can be found on the website, and there's links that will appear on the marketing material that you receive. So if anyone's got any questions, if they haven't, we've got some pre-prepared questions, just in case everyone's a little bit shy. So I'll jump straight onto those. So the questions I've got here is predictions for the rest of 2020.
Oh, Mystic Meg time.
Yeah.
So you notice the shameless plug that I'm making whilst we're having this little Q&A bit. I have this NACFB Awards 2019 logo. So it's voting time. So please, this is a subliminal message to say that we want to win this award again. So if you've enjoyed today, get on and vote for LendInvest as the best buy-to-let lender. 2020, I think I alluded to the fact that there's stamp duty front and centre of everything that's going on within the industry. We're certainly busy. I'm starting to hear that some lenders who are now seeing issues with their service levels are starting to panic about those service levels. And I think you'll see some maybe changing of the guard in the next few weeks, maybe month, in terms of lenders that will be pulling back in rates and lenders that are moving forward with rates as well. So it's all about grabbing as much business as we can during this year from landlords looking to purchase property initially, taking advantage of the stamp duty window, and also incorporating their portfolios, moving them from personal name to limited company, because the stamp duty saving on that is significant.
Okay, and post March 2021, when stamp duty ends, or the reduction in stamp duty, or the holiday ends?
Yeah, the cliff edge. Then? Yeah, the cliff edge. What's going to happen? You know, my personal opinion is that will the government want there to be a massive cliff edge? Will they want there to be another drop? Will they extend the payment holiday? Will they change the stamp duty payment holiday? What are they going to do? That's an interesting thing to look out for. I think that the remortgage business that we're seeing at the moment is probably savvy landlords gearing up for an assault on the market post March 2021 to pick up some security, some property that's actually well priced, some property that's left, that's available for them to snap up. It's quite funny, really, because all that's happened is the stamp duty's being removed and house prices have gone up. Is there a real saving that people are receiving at the moment? But at the end of the day, I do believe that there will still be a buy-to-let market in April 2021. I still think that landlords and brokers altogether are very resilient, and I think that there'll be some good opportunities available for everybody for some good property to purchase.
Okay, we haven't got any questions, Andy. So one thing I'm just going to add right at the end, and again, this is probably the third time I've blown some smoke, but really throughout lockdown, we found LendInvest to be one of the most proactive lenders. It does help that they've got a system that is pretty much, it's all IT, relies very much on the IT side. So we're not relying on the post office to deliver or for return signed offers, anything of that nature. We're not having to certify passports, council tax bills, anything of that nature, and really has been a breath of fresh air. And they really, if you've not used them before, seriously think about adding them to your list of lenders onto your panel, because they are great to have on board. And of course, as a packager, if you come through us, you get the same as if you went direct. And if you're not one that wants to give advice on cases like this, then we can help you on those as well. So, Andy, I'm going to say thank you very much. We're slightly behind time, and that's not your fault, that's my fault. So we will now move on to the next speaker. Okay, as you can see from the slide, we have Marie Grundy, Sales Director at West One Loans, who has just being added now as a speaker. So I can now just go through her slides. So you should have received by email today, again, the West One Loans second charge mortgage product range, dated September 2020. Check your spam if you haven't got it. We've also found out whilst Andy was talking, there is a way of actually uploading these onto the software that we're using for these webinars. So we're probably going to do that for the next one. I'm not going to try it today. So a little bit about Marie, first of all. She's been around for more years than her looks suggest, as you can imagine. She joins West One as Sales Director 2017, oversees the sales management, distribution, marketing and product development for West One's second charge division. She's worked within the mortgage market for over 25 years, starting out as a graduate trainee for the Yorkshire Building Society. Prior to joining West One, Marie was Managing Director of Specialist Distributor of V-Loan, so she's got broker experience as well. giving Marie a unique insight into the market from both the perspective of broking and lending. And she also has senior positions within the specialist lending market over the last 17 years, including a board position with the Association of Mortgage Intermediaries. I voted for you, Marie. And also recently appointed onto the board of the newly relaunched Society of Mortgage Professionals. I didn't vote for you on that one because I wasn't aware that it existed. So Marie did give us some interesting facts. She only gave us a second one, which she appeared in a Brian Adams video. The first one she omitted this time around. She did actually tell us this one all the way back in July when she did her last presentation, in that she's a closet WWE fan, which is the World Wrestling E, whatever the E stands for. Her son got her into about 5 years ago, and she now enjoys the live events a little bit too much. If you can imagine, if any of you ever used to watch World of Sport and the wrestling with Big Daddy and the likes, and there was always the woman with the pointed glasses hitting one of the baddies with her handbag. That is now Marie, unfortunately, apparently. She went to New York to see SummerSlam and met The Undertaker, and she's ashamed to admit, or probably isn't ashamed now, she's been known to push the odd child out of the way so she'd get up ringside to high-five the superstars. Their own, I suppose. My wife is a bit of a fan of that as well, I must admit. So next presentation will start in a few minutes. I'm just going to load your presentation out. Then Marie, it's all over to you. And you can hear and see and everything else, and I think I can hear you. So your presentation coming on now, and over to you.
Thank you very much. Good morning, everybody, and thank you for that introduction. I don't know where I go from there, really, Tony, but thank you very much. Just picking up on Andy's presentation, which was excellent. When he slipped up and told you to send his applications to InterBay, I think he actually meant West One. But yeah, thank you very much for that plug. Okay, so I'm here today to talk to you about the opportunities for second charges. And what I don't want to do is just talk about the sort of standard reasons to consider a second charge, but try and relate it to the current market conditions that we're all experiencing, just to really highlight some of the ways second charges can support your clients. So just a brief background on West One for those of you that are not familiar with us. We are probably one of the fastest growing specialist mortgage lenders. We're part of the Emma Group of companies, and we have a very diverse range of specialist lending products. We are probably a top 3 bridging and development finance lender now. We launched our second charges in 2017 and have grown that business to be a top 3 second charge lender within a very short space of time. And most recently, we launched buy-to-let mortgages last summer. And we'll continue to obviously look at our product range to see where the opportunities lie for us. We are a non-bank lender. We have been actively lending throughout the pandemic and supporting the specialist lending market. And you may have seen in the news this week that we've announced we've just priced our first securitization, which, given the market conditions, is a huge achievement for our business. But that means that we have the capabilities to continue supporting the specialist lending market, for the long term. And we're already looking at ways that we can extend our proposition and make that more compelling. So, we only want to drive origination. We're certainly not looking to contract through credit risk management or other areas. So I know some of the other divisions have got some products coming out next week, and hopefully from a second charge perspective, we will be closely following suit. All of our products can be accessed via Tony's firm, Specialist Financial Services. So some areas of our products are not available directly through intermediary channels. They are only available through key partners. So particularly for second charges, that is the way to access our products. So in terms of looking at the impact of the pandemic on the mortgage market, I think it's fair to say advisors in the last sort of 10 years have really come to the forefront with, 2/3 of mortgages being arranged by advisors. the FCA undertook the market competition study, which really was trying to move away from intermediation and put the choice of how mortgage products were accessed back into the hands of the consumer. And I think what the pandemic has done once again is highlight the value that you as advisors can provide to consumers, and more than ever now, borrowers need that intervention. You know, life has got more complicated. Lenders have across the board made adjustments to credit risk, obviously to align ourselves with the current market conditions and the challenges, some of which, you know, we know are to come with the end of the furlough scheme looming at the end of this month. So it's just generally made the process of obtaining finance more complex. So it's obviously critical for advisors to make sure that wherever possible, clients are going to be put in the best possible financial position. So second charges are renowned for being able to assist particularly with debt consolidation, and what we're seeing now are savvy advisors making sure that even if borrowers are not at risk in terms of their job prospects, that they're just making sure that if in the future there were any changes, that they've got the best possible opportunity to maximise household income. As it's been well documented this morning already, we know that service levels have really deteriorated across the first charge market, and we've seen some element of that within the second charge market, as I know Tony alluded to earlier. But generally in the second charge market, the service levels are still excellent, and our own firm, we're still delivering same or next day updates, despite seeing a massive influx of business in the last 2 to 3 months. So certainly in terms of speed of service, a second charge can really deliver still. And we all know what the issues are in terms of higher LTV products. They're limited in supply. That's had a massive knock-on effect of service and meant that lenders are using tools such as product withdrawals and increased credit scores to try and control volumes. And so there is a way that second charges can work in tandem with the first charge market to help customers achieve their financial goals. So we'll come on to some of those opportunities in the next slide. So what I really want to do is over the next sort of few months is sort of lead the way in terms of thinking differently about second charges. So there are a number of areas you might never have thought about a second charge being a suitable option for certain scenarios. So one of the areas I'm quite passionate about at the moment is the bank of mum and dad scenario. So I think Legal & General released some research last week that said that 56% of first-time buyers under the age of 35 were supported by financial contributions from parents. And second charges can be used for this specific purpose. So if you've got you know, children or grandchildren that are struggling to get on the property ladder, or that if they had the benefit of a larger deposit, wouldn't need to be scrapping around looking for 85%, 90% deals, then this is one area that you should maybe consider a second charge for. And we're going to be looking to provide some specific criteria in this area just to really propel that. The other area we've talked about a lot already this morning is the opportunities within the current housing market with stamp duty concessions, and second charges again can be used to raise either deposits or full funds towards property purchases. So we're one of the few lenders that has a range of residential and buy-to-let second charges, and I'll talk in more detail about buy-to-let second charges later on. But that's another area again where, particularly with the timescales, and we know that that's going to become very challenging as we move into next year, that there are ways that a second charge might be able to speed up that process and make sure that those stamp duty deadlines are met. And the other area, again, second charges are ideal for financing home improvements, big or small. So we have loans, for example, available up to £500,000. And we are seeing increased demand for larger loans at the moment. I think the availability further advances within the first charge market is either reduced or the service standards are so terrible that it's actually quite a poor option for clients in a lot of instances. So we're helping quite a lot of high net worth clients, for example, with larger refurbishment projects. We actually helped Tony and his team fund a 350 grand deal a couple of months ago for a huge sort of home improvement project. So there are opportunities there, particularly in this sort of current climate where borrowers are feeling more inclined to make those changes to their existing property rather than move. And buy-to-let second charges as well are probably a lesser known product because there are fewer lenders that offer this type of product. In the second charge world, there's probably about 3 or 4 lenders maximum that are actively lending in this market right now. We have market leading rates and recently made some further improvements to our product proposition. So I'll cover that in more detail later on and some of the opportunities there. We've also seen changing structures within the mortgage market. So if you cast your mind back to over 10 years ago, 2-year fixed rates would have been the products of choice, remortgage again in 2 years' time. Whereas what we've seen in the last 2 or 3 years with the sort of uncertainty around Brexit and the lower cost of swap rates, which means that there's less margin between 2 and 5 year fixes, is that there's been increased take up for first charge 5 year fixes. And that means that there's less opportunity for advisors to go back and remortgage those clients as they would have done over a shorter term. So whilst they're in a longer term fixed rate, the chances are they're going to have early repayment charges applicable during that term. If they do need further borrowing, again, a second charge could be a great way of addressing those needs. And then the other big change we've seen in the mortgage market is the rise of the product transfer market. So specifically on that topic, in Q4 2019, there was actually 44.3 billion of product transfers, and actually almost half of those were completed on an execution only basis. So we all know banks and high street lenders are getting more aggressive at trying to get to the borrower before you do, and seeing this level of execution only is a concern, because it means that you've not had those conversations with your clients in terms of what the borrowing needs might be. So any additional borrowing needs won't have been addressed at the time of the product transfer. So it's a really great opportunity, if you are offering second charges, to go back, have those discussions with your client in the interim period, just to see if there are any ways that you can extend your service to meet those needs. So how can second charges add value? There's always a topical debate, and I know there was an article recently by another specialist distributor about the number of brokers that are not offering second charges. And, you know, some brokers will go out and say you have to offer second charges, and that's actually not true. If your scope of service is just limited to first charges, your obligation is to make the borrower aware that there are other products that might be more suitable, including second charges. But if in your scope of service you're including second charges, or you're describing your services as independent, then it is mandatory that you consider second charges alongside remortgage. So I think there is a really distinct difference there in terms of what your regulatory responsibilities are. But putting that to one side, actually, in terms of being better at what advisors do and extending their scope of service and skills, then including other specialist lending products such as second charges is a great way of producing potentially better consumer outcomes and actually moving more towards holistic advice. And I think the options within second charge means that you don't even have to provide the advice on second charges. You can outsource that to Tony and his team. If you want to take more of a lead and actually retain responsibility for the advice and use Tony and his team to actually process that loan for you, those options are also there. So there's lots of different ways that second charges can be arranged that suits your business model. I mean, at this moment in time, we all know resource time is horrendous, and you know, I've got some mortgage broker friends who tell me that they're doing, you know, they're working twice as hard for half the income. So if you just want to hand off the whole process, again, that's an option for you, but at least you know that you are still catering for your clients' needs in an appropriate way. Some of the more traditional reasons for considering a second charge, we've already touched about borrowers who might be in early repayment charges. So the key benefit of a second charge is it really allows you to keep your clients' mortgage arrangements in place without disturbing them. So if they've got a preferential rate, or they've got an interest-only mortgage, perhaps where on a remortgage they'd lose that and they don't want to do that just at this moment in time. Or it could be they've had a change of circumstances since they took the loan out, so it means that they won't actually qualify for a lower rate. Then these are ideal ways to consider a second. There's also lots of flexibility around second charges in terms of term and loan purpose. So you don't have to take the loan out over exactly the same term as the mortgage. You can take it over a shorter or a longer term, and pretty much any legal purpose can be considered for a second. In terms of speed of completion, sometimes there isn't a need to do a physical valuation. Automated valuations can be used. There's varying appetite between lenders, but pretty much every second charge lender has some criteria to support AVMs and drive-by valuations alongside physical valuations. And one of the other big advantages is that once the offer's issued, there are no post-offer conveyancing requirements. So all lenders use in-house legal teams, and usually when that offer's issued, it's up to the client how quickly they want to complete. If they want to complete within 24 hours of the mortgage offer being issued, they can do that. I know my brother remortgaged last year, raised some money to do an extension and got the offer within days. The service was fantastic, but then it took him another 7 weeks to get the money because he was stuck with a panel conveyancer. So these are the areas again where speed's important. A second could be a better option. There's other areas as well in terms of niche lending for borrowers who have bought the property in a sole name and want to add on their partner to the application. You can actually do that with a second charge, even if the first charge mortgage is only in one name. And conversely, if they want to keep it in one name, there are some lenders such as us that will actually consider that as well. In terms of an example, a case study, so one of the great case studies really is around interest-only borrowers who are with a lender who offer further advances, but only on the basis that it's conditional upon that mortgage being converted to a full repayment just to borrow some extra money. So in this example, we've got an interest-only borrower with a £300,000 outstanding mortgage. It's got a great 5-year deal at 1.75% with a monthly payment of £437.50 and wants to borrow £50,000 for home improvements. And the only way he can do that with his first charge lender is to convert all of his borrowing onto a repayment, which means his payment is flipping from £437 to over £1,400 based on a 20-year term. So that additional 50k borrowing is going to cost this borrower an extra £1,000 a month. If that borrower to take a second charge out instead, they can leave obviously their interest-only payment in place at £437, and that extra £50,000 at a typical rate of 425 is going to cost them an extra £309 a month. So a big difference between 1,000 and 309, which would mean they're actually saving just over £660 a month by actually taking out the home improvement loan by way of a second charge. So in terms of our actual loan range, we offer rates starting from 3.99% on our Primis plan. We currently go up to 75% LTV. There are lenders out there that are going up to 85%, 90% and above. So there are other higher LTV options within the wider market. We can also take up to 100% of overtime and commission if that's regular on a monthly basis, even for non-key workers. And one of our sort of key USPs is that our affordability assessment is an automated process. We have an automated expenditure assessment, but we don't apply LTIF LTI restrictions to the vast majority of our products. We have one product where the LTI is restricted to 6 times income, but the rest of our products are available without LTI restrictions, which can obviously be really useful. I've talked earlier about the fact that there are larger loan sizes available within the second charge market. Our maximum loan is £500,000. There are other lenders out there that go up to as much as £1 million. So there are some really great flexible options out there at the moment. And like I said, any legal purpose is generally considered for second charges with older borrowers as well, up to age 85. And all our products are based on bespoke underwriting. So we use credit assessment tools, not credit scoring, which is helpful for borrowers who don't quite hit the mark with a credit score scenario in the first charge world. Coming on to buy-to-let second charges, so this is an area again of growth, particularly with the opportunities in the property market at the minute. So it's an excellent opportunity for part-time and professional landlords who want to release equity from their investment property. So typical loan purposes are refurbishment of their existing rental properties, which can increase not only rental yield, but also the value of their assets. As I've mentioned earlier, you can use this to facilitate further property investment opportunities. So we accept up to 3 applications per borrower for buy-to-let borrowers, which means they could take equity out of up to 3 properties, up to a maximum of £500,000 to fund a purchase outright, or whether they want to look to raise deposits towards the purchase to keep the cost down on the first charge loan. That's something we can definitely consider. And also you can use it for personal use, such as debt consolidation or home improvements to the landlord's main residence. So we have a case study recently. This is a case we completed during lockdown, where they were looking to raise £95,000 for property purchase. So he had an existing first charge with a high street buy-to-let lender, had great terms on there, so he didn't want to disturb those arrangements. He'd got a reasonably sized portfolio, and all the mortgages within that portfolio have been conducted really well. So we just assumed they were all self-financing. We don't go into too much detail on properties in the background from a buy-to-let perspective. We just want to understand how landlords can meet any potential rental voids. And this actually was the client who was employed as a train driver. So his main profession isn't a landlord, he's a part-time landlord, but building up quite a nice portfolio of properties. And he met our minimum income requirements of just £15,000 from either employed or self-employed income. So we actually arranged an interest-only buy-to-let loan for this particular borrower at a rate of 649. He actually then came back to us for a subsequent loan to fund another purchase since. So we've done 2 loans for this particular borrower, and that's quite a common theme that we're seeing within the buy-to-let world right now. So in terms of our buy-to-let range, we recently brought back quite a bit of pre-COVID criteria back in September. So our LTVs are up to 75%. It includes consumer buy-to-let products as well, which are in shorter supply at the moment. And we can lend up to £250,000 up to 65%, with reducing loan sizes across the 70 and the 75% LTV banding. And we use a very simple debt service calculator, which is 125% for basic rate taxpayers, 145 for higher, and 165 for additional. And on our buy-to-let range, we have full interest-only options up to 25-year terms. So we can help portfolio landlords, we can help licensed HMO properties, we can now consider expats on referral, preferably if they live within an EEA country. And as I mentioned earlier, up to 3 loans per borrower, so they can actually access equity across a range of portfolio properties with our second charge product. So in summary, if you're not considering second charges already, please do so. It really will add some value to the service that you offer your client and really help deliver some much better customer outcomes if you're not already doing that. It's not right for everybody. It might be you look at 5 cases and a second charge isn't right for those clients, but the 6th one, you can really make that customer end up in a much better financial position. Just be mindful of your regulatory responsibilities in respect of your scope of service. And if you do need any help with advice or research, then I know Tony and his team are huge experts and have, as Tony mentioned earlier, years and years of experience in this market. And just remember the point on speed of completion, particularly at the moment with the service levels that are being experienced throughout the mortgage market, and the fact that the borrower generally doesn't need to have any separate legal representation unless they need any independent legal advice because of their ages or the loan purpose, but there isn't any requirement for them to act on their behalf in terms of the completion. And there's lots of niche lending opportunities within the second charge world. And don't forget that all our lenders within this market operate with a bespoke approach to underwriting. So I shall hand back to Tony and the team, but thank you very much for the opportunity there, Tony.
No problem at all, Marie. Thank you very much indeed. Bang on time as well. So it was me that was late, by the way, on the first presentation. So if you do need access to any of, and you'll see this as a common theme for each speaker, we've got everything you need is on our website, on the Specialist Hub website, decision in principle forms. Basically, every document that a lender may have that will be relevant to what you would do will be you'll be able to find on our website. So what we're hoping is eventually we'll be a one-stop shop for lender documentation. Obviously, if you need to discuss a case, the telephone number's there. That goes straight into the relevant team. One thing Marie didn't mention, because it's not her side, but we're also one of the accredited packages on the buy-to-let side as well. So if there's something you want details of, that is available on the website, or I can email you information pretty much immediately within seconds. So Marie, we've not got any questions from the delegates, so I'm just going to ask you. Here's some I prepared earlier.
I think one just popped up, Tony. Actually,
sorry,
there's a question's just popped up from Bill.
Oh, sorry, Bill. Apologies. Okay, on a resi second charge, what percentage of bonus payment will you use?
Yeah. So in answer to that, generally, unless they're a key worker, we're not using bonuses right now, just because, again, most bonuses are paid annually. And I think it's going to be unlikely that bonuses are going to be paid in the same way for a large proportion of borrowers. If you have a borrower that has a regular monthly bonus in the same way that they get monthly overtime or monthly commission, that's something we could look at on a referral. But if they are a key worker, we are tending to take more of a pragmatic view around bonuses, but generally not something we're comfortable in considering right now.
Okay, thank you for that, Bill. No, okay, thanks. Yeah. So yes, the questions we've got: what are the real opportunities for second charges at the moment?
Well, I think it's really looking at where the challenges are in the first charge market and what can seconds do to help that. So obviously, I've mentioned this morning about further advances being a great example of that. So we know that in terms of service, further advances are suffering because of that. So lenders are withdrawing products, or the service times within sort of ancillary products are taking much longer. So seconds are a great fit, as you know, for home improvements. And so that's an area that I would really strongly recommend. And then again, going back to the discussion around bank of mum and dad. So if you could imagine that you could release equity from the property to give your child access to a 75% LTV product rather than a 90% product, not only are you making savings, but there's a much wider availability of those products in the market at the minute. So we're just really trying to find ways where second charges can support what intermediaries are trying to achieve within the purchase market. And in terms of speed of completion, again, stamp duty, the clock's ticking, drawing equity out of buy-to-let properties as an alternative to a remortgage could again be critical in meeting those deadlines when it comes to the end of March.
Okay, one final question then. Why can I not submit second charge applications directly to West One?
So our operational capacity for second charges particularly is for us to distribute our products exclusively through specialist second charge advice firms. So we work on the basis that we deal with a limited number of firms who are highly experienced in this area of lending, such as obviously Tony's team, and that way you get expert advice not only for West1 products but across the whole of the market, and the processing for second charges is different to the first charge market. So we operate on a fully packaged submission, which is why again we need brokers with that relevant expertise that are regularly completing second charges to work with us.
Okay, and we do deal with an explanation in my last presentation at the end of today as how you can access West1's products without the daft broker fees or packager fees that are being charged. So, Marie, that's lovely. Thank you very much indeed. We're slightly behind time, but not your fault. You were bang on time this time around. So well done, brilliant as always. Right, everybody. So we'll say goodbye to Marie.
Thank you, guys.
So welcome, Ash. Can you hear us?
Yep, yeah, I can hear you. Can you hear me okay?
Absolutely fine. So I'll just crack on with this. So everyone, you should have received this on email this morning. There's two pieces. It's the buy-to-let mortgage products and the semi-commercial products. So take a look at those if you've had them in the post. Obviously, you can look at the hard copies. A little bit on Ash first of all. InterBay Commercial was acquired by One Savings Bank 2012, has become one of the largest lenders in the commercial specialist buy-to-let and bridging market. And Ash joined InterBay Commercial team in 2020, having worked in their underwriting department since 2018. Well versed in the industry, and he brings with him a wealth of experience and knowledge. And an interesting fact, Ash tells us he's never broken a bone in his body. That was back in July, so hopefully nothing's happened since.
No, still safe, still safe.
He has broken a bone of some sort, but so that's pretty much it. So Ash, I'm going to just move over very quickly to your presentation, and then it's over to you.
Perfect. Brilliant. Okay, so good morning, everyone. So today I'll be going through essentially who InterBay are, what we do, and just talking a bit about our proposition and our HMO and buy-to-let aspects as well, diving a bit deeper into the HMO world as well, and just why that can be a good diversification point for some of your clients as well. So first of all, who we are and what we do. So first of all, we're a lender in the specialist mortgage market. We deal currently with semi-commercial and buy-to-let loans. We also pre-COVID did commercial and bridging as well. Now we do expect those to be back at a point in time, but at the minute it's just limited to semi-commercial and buy-to-let. So we also do large HMOs and multi-unit freehold blocks as well. So these are typically where we probably come into our own a bit more, and we specialise in these types of properties, as well as the portfolio buy-to-lets, as opposed to usually the individual deals for one property. So we've got an in-house expertise in terms of underwriting. So we've got a team of underwriters that work in the office. We've also got a real estate function as well. Now the real estate function are useful in terms of certainly the valuations, assessing properties, assessing securities. It's good to sound properties off of them before sometimes we get a deal in as well. So in terms of our criteria, we are very flexible. As Tony mentioned, we're part of One Savings Bank, who have Precise and Kent also offering propositions in terms of mortgages. So we are probably at the far end of the spectrum in terms of our manual underwriting. So all our cases are reviewed individually. There's no kind of computer says yes or no. And yeah, with that, it means that each case gets, I guess, a bit more attention, maybe slightly slower in terms of the process of getting it through, but for the more complex cases, it's certainly worth its weight in gold. We've got a national BDM team, so the BDM team covers the whole country as well, which is always good. So moving on to the buy-to-let criteria for us. Now, we've almost got two sets of buy-to-let criteria. So we've got one that sits from 1 unit up to 6 units. So whether that be a HMO or a multi-unit freehold block. So these ones we can do up to 75% LTV. We've got a minimum loan size of 100,000. And we can deal with complex ownership structures. So if they've got a multi-layered company, or if they've got a trust, or anything like that, any trading companies, we can also do those as well. Again, the guys in-house in the underwriting function, they used to dealing with these sorts of properties, so we can do those. It's available in England and Wales only. We're currently offering a 2 and a 5 year fixed product at the minute. We did have a variable pre-COVID, but that's gone for now, just because of the volatility that we're seeing in the market. So large portfolio loans, again, we can do, you know, if someone's got one buy-to-let they want to bring to us, that's absolutely fine. If they've got 100, we can also do that as well. So maximum loan size of 1.5 million is kind of advertised on our site and in most of the info that goes out. What I will say is if you have got a complex deal or anything that's over that 1.5 million, it's definitely worth getting in touch with Tony and his team, because it might be one that we can do. Certainly, if it's a good enough deal, we're more than happy to look at it at the minute. So, and yeah, this is available on purchases and remortgages. So the second part of the buy-to-let criteria is slightly higher. So this is the 7 to 20 bedroom units or multi-unit freehold blocks. This one we've got 70% available as a max LTV, so it's slightly lower. Again, it does say that we can do up to 20 bedrooms. If you've got anything higher, 30, 40, 50, then get in touch with Tony and the team. It might be one that we can still look to do, subject to us taking it to our credit committee. So yeah, student accommodation as well, and they are considered. What I will say with those is that if you've got a smaller unit that's maybe six bedrooms that's down a residential street, we would treat that as a buy-to-let proposition, because it could be converted into you know, a normal buy-to-let for say working professionals, for example. With the purpose-built or the purpose-built student blocks, we do treat those slightly more commercially, and what we just need to be aware of there is, you know, especially with everything going on with the localized lockdowns, are the unis still having students in? Are they doing online lectures? You know, what's the demand like? Whereabouts is it? So we just need to be careful on the more purpose-built properties. But again, if you send those in, we can get those assessed for you. With these larger blocks, we do undertake an investment valuation, which we find to be really good. Certainly in terms of your clients, if you've got any landlords that are looking for that more commercial valuation on it, then this is the way that we'd go on it. So instead of taking it just to bricks and mortar, what we do is we do it on a yield-based calculation, which would also take into account almost the value of them having, you know, eight units already tenanted as well. So that's more appetizing to potential buyers. So government support schemes, just so you're aware, things like the bounce back loans and C-bills are absolutely fine for us. The only thing you can't use them for is as a source of deposit. But we're comfortable if people have taken them, then that's absolutely fine. And also, if we've got anything on like furlough income or SEIS income as well, then that can also be considered as well, provided that they can just evidence that. That's absolutely fine. So on our semi-commercial side, at the minute we're just doing up to 60% loan to value on these. Now that will be hopefully increasing in the future. I think we're slowly gaining more and more confidence in the market, especially as things start to normalise a bit in terms of restaurants trading, things like that. So convenience stores. So what we might see is that actually that will increase hopefully in the coming weeks. Now we've got a minimum loan size at the minute on this of 150,000, a max loan size of 600,000, and also a maximum property value of £1 million. Again, anything above that, if it's a good deal, then absolutely speak to Tony and the team, and we can always chat that through. So again, 2 and 5 year fixed on this one. Now the commercial element does need to be trading on these. Can't really have it where they're vacant at the minute. So the residential income is also the only part that we would use when we're calculating the ICR. Now the reason we're doing that is just because there is a chance that the commercial units may stop trading or may be forced to stop trading, provided that they meet that 125% ICR. On the residential parts, that's not going to cause too many issues, because it means actually if the commercial stop paying rent, actually the residential parts will cover it, and it won't be any issue for the landlord either. Again, these cases are fully underwritten, but with the semi-commercial cases, the only slight difference to buy-to-let is that we actually underwrite them fully prior to valuation instruction. And that's just because, again, we need to make sure the numbers stack up on these ones before the client spends even more their money. So, brilliant. So just moving on now to the growth areas that we're seeing in the business. So certainly buy-to-lets, any adverse or near prime properties. If we've got any shared ownership and help to buy, more on the Kent Reliance side, again, part of the group, that look more at that than we do specifically. Self-employed, if you've got trading companies or sole traders looking to invest, then absolutely we can do that. Later life planning. So a lot of people now are looking to purchase properties with that later life in mind and that retirement package in mind again. Commercial and semi-commercial, again, we're actually seeing a lot of transactional volume on the commercial and the semi-commercial side, which is, it's interesting because obviously the times that we're living in at the minute, but no, it certainly seems to still be demand for it as well. Now bridging, again, we're paused on this. Precise are still doing bridging, so part of the group there, but we hope to be back with our more complex bridging proposition hopefully next year. So just to talk about HMOs briefly, and really, I guess, how they can diversify some of your clients or the landlord's portfolios. Certainly a useful string to have in the bow. So a HMO, that is a property that is rented out by at least 3 people who are not from one household, for example, a family. So, but they actually share facilities like bathrooms, kitchens, living spaces, lounge, etc. If you want to rent your property out as a house in multiple occupation in England or Wales, then absolutely there's certain criteria that they need to be aware of. Certainly your landlords and your clients would need to be aware of. And I think if you can add value, certainly in terms of getting the knowledge around what they need to do and how they need to do it, it can be a real niche part of the market to target. So as this graph shows, 51% of brokers have been approached by landlords looking to diversify. Again, it's fine having a load of single buy-to-lets, for example. If you get a few, the issue with a buy-to-let, I guess, is if you've got one unit and that family drop out and you can't replace them, that's that income stream gone for that one property. With a HMO, if you've got a 6-bed HMO, if one person drops out and leaves, then you've still got 5 others still paying rental on that. And of that 51%, 56% of those inquiries were around diversifying into HMOs in particular. So it's almost a quarter of all inquiries, or just over a quarter of all inquiries around this. So it's, landlords are certainly starting to look at it a lot more. So why do they want to look at HMOs? So landlords want the best yields. So certainly in terms of the yield you would get on a HMO compared with a buy-to-let, if you've got one family unit on a 3-bed house, say rented out for £1,000, you could probably rent that out as 3 bedrooms at £400 each as a HMO, giving you £1,200. Old and larger properties can be renovated as well. So we certainly see it with office blocks as well. A lot of offices are now being turned into living space. So a lot of landlords are starting to go into the market now, buy an old derelict office building, get it on a bridging loan, convert it, and then turn it out onto a buy-to-let and HMO mortgage. A lot of targeting around university towns, large hospital and commuter towns. So if you've got certainly the suburbs in and around London, that we're seeing a lot of demand in there at the minute, and also where you've got large hospitals and universities, a lot of HMOs are coming up around there for the convenience of obviously those at the unis or at the hospitals. And it provides an opportunity to purchase away from the southeast as well. So in terms of the yields you'll still get really good yields pretty much around the country. So region with the highest yield at the minute is the Northwest at 6.2%. And the fastest rent growth is seen currently in the East Midlands. So it rose 2.3% from last year. Okay. So here we have an example of what a HMO used to be classed as, because the definition has changed recently. So it used to be defined as a property with 3 stories, had to house 5 or more people, 2 or more from separate households with shared amenities. Now that has changed really to simplify it and just make it a lot easier across the board, because obviously not all properties have 3 stories, but you could have 8 people in there, and it just wasn't really a fitting definition for a HMO. So in terms of what's changed, they've added new licensing laws to redefine a HMO. New mandatory floor size, which ends overcrowding and rogue landlords, because what we did see historically was that there were pretty much, you've heard the term probably, slum landlords. You'd have small box rooms that weren't really fit for living, weren't fit for purpose, and it was quite unregulated. And this could just, you could flip a property pretty quickly and essentially turn it into a cash cow and just try and milk all the money from it, as opposed to actually having concern over the tenants and their well-being. So there's no longer a requirement to be 3 stories. Again, a bit of a nonsensical one, because if you had a big, long 2-story house, then absolutely you could fit a lot of people in that as well. So existing HMO licenses were valid until the expiration date of the individual license, but beyond that, they do need to apply for a new license, which will be made through the local council. So this is now the definition of a HMO. So you can have one household with 3 brothers and sisters living it together. That's not a HMO because that is a family unit. So the next 3 are HMOs. So the first one, got 3 unrelated friends living together. Again, 3 separate households. That's a HMO. If you have 4 people in there, 2 couples and 2 couples that are living there together, that would be classed as a HMO, because again, it's more than 2 households, 3 or more people. And the last one is if you've got 2 households living together, one's a couple and one is unrelated. Again, because it's 2 households or more and there's 3 or more people, that's classed as a HMO. So it's really simplified the definition on that there. So approximately 177,000 HMOs are going to be affected by this new mandatory licensing, and there's not been any grace periods. So they all had to have a license if they didn't, by the 1st of October 2018. And the minimum size requirements for the rooms. So what they've done is define that there. So that just gives it, basically allows what's deemed to be a habitable space that is fair to the tenant and doesn't involve them being in a box room or cramped up or having overcrowding in any rooms at all. So why do they make these changes? I mean, this picture pretty much sums it up. This is actually an actual picture from a valuation report. So yeah, number 1, rogue landlords. So you get pictures like that where you've got what appears to be a kitchen / bathroom with some pretty dodgy wiring and a cooker quite nearby as well. So overall, not really safe, not really fit for living at all. So it's done to protect the tenants. Again, this photo pretty much sums it up as it is. Refuse collection as well. So if you had overcrowding, 8 people in a 3-bed house and you had a lot of those down a row, it's going to create a lot of rubbish. And we did see that there was a lot of rubbish just being chucked out on the street because the bins weren't collected in time for the amount of people that were living there. Gas and electric. So now everything needs to have, be certified and be approved, which is really good. Again, smoke alarms and the EPCs have all been brought up to a certain standard now. So it just means that you can't have that rogue landlord. It's all got to be done properly, and it provides a good living space for the tenants. So in terms of planning, so the planning system in England and Wales is actually pretty simple now. It's just split into 3 different options. So you've got C3, which is your residential house or flat occupied by a single family. And then you've got C4, which will be the shared houses, so the HMOs between 3 and 6 unrelated individuals. And then you've got the sui generis, which is anything above that. So it's any HMO that doesn't fit any of the other definitions. And normally you'll see this, on 7+, it'll be deemed as HMO, sui generis planning. So they just need to make sure that they've got the right planning in place and the right licensing as well. So just moving on to Article 4 areas. Now, Article 4 areas are put in place by the local authority, basically to limit the amount of HMOs that are in there. Because obviously you're looking through the presentation and thinking, well, HMOs are great. Why doesn't every landlord snap up all the properties and just build HMOs? Well, it's basically to limit things like the refuse collection, making sure that the council tax they're paying for can provide them with enough amenities in services and things like that. So what they've done is they've essentially cordoned off areas and said, look, you can't build or you can't get HMO license in this area without coming through the council and getting it approved. As far as I'm aware, I don't think there are many councils that like to approve them in the areas unless there's a real demand for it or the demand has shifted, mainly because they put the Article 4 in place at the minute because there's an issue. You can get details through the local council. They're quite hard to obtain around what is an Article 4 area, but it's more just something to make your clients aware of. Because if they're about to buy a property that's a buy-to-let and turn it into a HMO and it is an Article 4 area, they might be stuck with it as a buy-to-let property. So, yeah, like we said, there's lenders that can help. So first-time landlords, we can certainly do that. We've done first-time landlords, provided that they are a residential homeowner, then absolutely we can take that on. What we won't do is look at, a first-time landlord that's looking for an 8-bed HMO. we'd like them to get a bit of experience first. So start off with the buy-to-lets, then move into the HMO market. You know, if it's a slightly bigger HMO they're going for as a first purchase, like a 5-bed, we might ask they get a management agent in place. Again, the best rental approach, that essentially means that for 1 to 6 beds, we look at it more on a bricks and mortar basis. Anything above that, we would tend to look at it on an investment valuation. Now that means, again, that we can look at that commercial aspect and look at it more as an investment. You know, if they're going to sell that on with 8 tenants in situ, it's going to be worth a lot more than selling it on empty. So we can take that. Like works for the property. Now we're not currently doing bridging loans at the minute, but what we can do is if it needs a quick touch up, quick refurb, and you know, one of the bathrooms, actually, you know, provided they've got 3 months cash reserves, for example, we can look at potentially doing it where they can go in, have that 3 months, and then get the tenants in. So we can allow them to undertake some light works to the property, but nothing major. So we also offer further advances at InterBay as well. So if they come to us with a property, typically we saw some bridging where they'd flip it and then look to borrow more off the back of that. But yeah, we can offer that. And certainly the product transfer is being looked at the minute. So what we're looking at is a product transfer where we can go straight from a bridge into a term. Something similar to Precise have that functionality at the minute. Directors and shareholders. So at the minute, yeah, we will look at usually just taking PGs from directors, but in terms of the shareholders, they'd just be the guys that would sit on the application. And yeah, all we'd need is above 51% shareholding, and they can put a mortgage for us. So that's absolutely fine. So in summary, HMOs are becoming increasingly popular for landlords looking to diversify their portfolio. And like we said before, if it was easy, everyone would do it. So I think it provides a real good space for you to target. You know, if you've got clients that are looking to diversify, this is a really good space to go into. The yields are great. The management is a bit more intensive, but certainly it will diversify their policy, their actual portfolio, and make sure that they've got a continuous income stream. Usually, even if 1 or 2 drop out, they've still got 5 or 6 other people in situ there. So InterBay commercial specialists in HMOs, and you know, the guys in the office, they look at it all the time. It's pretty much their bread and butter. So yeah, in terms of advice and any help, certainly, you know, Tony and his team, and I guess, you know, our in-house underwriters will have a whole look at the case on a holistic view. So yeah, certainly in terms of how we can help you with this, get in touch with the expert team at Specialist Commercial Finance. Speak to Tony and the team. You know, they're more than well versed in what we do. So yeah, it provides a good opportunity, and there's certainly a talking point if you've got clients that are looking to diversify on that as well. Yeah, and there's
thank you very much for that. I really appreciate it. I've just seen a spelling mistake on this slide. Actually, it's called forms, not frums. But thank you for stepping in at such short notice. I can imagine this morning you was probably running around like a headless chicken, trying to get ready, trying to get the banners up behind you.
Yeah.
But no, it literally was. It's been Chrissy only advised us. I think it was just about 10:20 that she was feeling unwell. So if you step into this short notice, is absolutely brilliant. Our biggest fear when we run these is that lenders just all of a sudden say, "Sorry, can't do it," and then we're left trying to fill a big gap in the presentations. So we've not got any questions come up from any of the delegates. So I've got a couple of questions just to ask. I have a landlord with a large student accommodation, which is a 6-bed HMO, but there are also 2 self-contained flats, and I can't see the rest of it, unfortunately. 2 self-contained flats as, bear with me 1 second, because that doesn't fit within the spreadsheet I've been given. So I'll get this up on the 2 self-contained flats as well. Is all on 1 freehold. Can you do this?
Yeah, absolutely. So that again, it is part of that complex piece that I guess we specialise in. So if you've got a HMO with also 2 flats on there as well, that is certainly something we can do. We would look at it again on an investment valuation basis, usually, because you've got a 6-bed HMO and you've also got the 2 flats. So again, if one of those tenants leaves, you're still left with 7 occupied units. So in terms of that, we'd look at that on an investment valuation basis. But yeah, that's absolutely something we can do. And those sort of complex structures, I guess, are where we kind of sit in the market.
Okay, one final question. Again, I've got to turn to look at my other screen for this because it doesn't fit. The question's too long to fit within this. My landlord has an HMO with a license in place, but there's no planning. Are the license and planning application not one and the same?
No, and I think this is probably where a couple of landlords, or certainly first-time venturers into this market, can get tripped up. So the license essentially is a tick box really exercise, saying you've got your EPC, you've got your gas, you've got your planning, etc. And that's more just of a final sign-off. Certainly the license, if they've got everything else in place, the license should be granted. The planning, I guess, is the big issue. If they've not got planning, so if they've got C3 use for a single residential home, and it's actually they're using it as a 3-bed HMO, and it's not got planning, then essentially they can all the tenants can be turfed out, and then you've got things like compensation claims. It can cost them up to probably up to about 10 grand loss of the property. So they'd have to turn it back to a buy-to-let, but in the meantime they'd also have to cover the expense of those people that have been evicted, which is going to start mounting up quite quickly, certainly in terms of if they've got a larger HMO that they haven't got planning for. So yeah, I would always say planning is definitely the most important thing out of if they're looking to turn a property into a HMO.
And unfortunately, a lot of the councils, we had a client recently, his HMO license, and the lady who came out and granted the HMO license said he didn't need planning for an 8-bed HMO. So he then just didn't apply for planning. And when it came to us, said, "You need planning?" "Oh, no, I don't." "Oh, yes, you do." It was like a pantomime. Eventually, he had to actually take bedrooms out to put it down to a 6-bed.
Yeah.
We told him what the consequences were, and he then actually looked it up and actually read the thing. So it's not just the landlords sometimes who don't know. The councils, the knowledge within the council sometimes is dire. So, right, Ash, okay, we're bang on time. So thank you very much for stepping in, as I said before.
Yeah, no worries.
Great presentation. Hopefully everyone's learned a little bit about HMOs that they didn't know before. So we will now go on to our final speaker, our final lender speaker. Okay, so we have coming up Avamore Capital, Adam Butler, who's now hopefully going to be added as, yes, he is. He's just gone on. Excellent. Okay, there you can see a picture of Adam. Adam's was actually our loan manager at Hampshire Trust Bank up until the start of lockdown, when he was actually changing jobs just as everyone went into lockdown. And of course, we then worried that he might not be able to actually move into the new role, but thankfully they have taken him on and haven't left him out in the cold. So just a little bit, first of all, you should have received this via email this morning when it loads up, the pricing guide, which Adam hasn't seen yet. I've actually condensed their 15-page document into a 2-page document, just purely to make it a little bit easier to read, and also the size of it was huge. It wouldn't gone through the email. So we've just we've actually got that. So get that ready in front of you. A little bit, first of all, about Adam. He's been with Avamore for just over 6 months, as I mentioned, as a relationship manager. Previously worked at HTB as a lending manager, and now lending manager. Prior to that, BDM, first for bridging, a broker, and someone's just clicked me off. Bear me 1 second. I don't know who's done that. Oh, I think Adam might have done that. Adam, don't touch any buttons.
Apologies.
Okay, it's back to where we were. Okay, so he started off in the finance industry as a mortgage broker, mainly in the residential and buy-to-let sector, and spent several years working for brokers such as Countrywide and Mortgage Advice Bureau. And his interesting fact, he once played football against Christian Eriksen, the former Tottenham and current Inter Milan midfielder, in the European Youth Tournament in Denmark. And his words, not mine. Safe to say we all know who won that battle. I can imagine. Haven't been in that situation myself previously. So just whilst we load up Adam's slides, Adam, where are you? Are you there? No, he was there and now he's gone. No, he's coming back.
Hello, can you hear me?
Yeah,
Apologies for that.
You're good to go now. Slides are up. Over to you.
Perfect. No, look, appreciate the introduction. I think certainly didn't put on there the score of that game. So as you can imagine, it was a fair few. But no, I appreciate you having me on, and an afternoon to everyone who's stayed on so far. Avamore maybe, I've seen a few names in the list of people I've spoken to, but Avamore may be a new name to some. So I think today really was just to give you a bit of an overview of ourselves, some key stats for ourselves over the last year, and also give you an idea of our 4 key products that we've got at the moment, some rates and some examples as well of how they can help. So first slide for myself. as I say, our primary focus is bridging and development. We've got 4 key products, which are our bridging, finish and exit, ground up, and refurb and conversion. We've just had our 5th birthday. As I say, been going for 5 years now. Always really focusing on the same stuff. As I say, right from day one, the bridging, the refurb and conversion, and certainly finish and exit have always been a key part of our business. Avamore was originally set up 5 years ago by 4 key principals who've actually come from quite a different background. Some have come from the lending development background. We've also got former surveyor, former solicitor as well, which I think gives us a really good understanding of not just, is it a deal worth lending on, but also the potential risks or pitfalls that might come up at the legal stage, understanding a surveyor's view on the property before we get the clients to pay for the valuation and monitoring surveyors' reports and things like that as well. So I think that's been a really good reason why they've done really well. Obviously, so I've only been here 6 months, but I think the drive has continued. The improvements year on year. Obviously, this year not quite the year that we all would have liked, but we've still been lending funds right throughout lockdown, and actually I think we're back now rate-wise and leverage-wise back to where we want to be. Which is really positive. I mentioned the loan book there, sort of 209. I think we're actually at 212 now. I think we've had a couple go since this was sent over. So a good loan book, and as you can sort of see in there as well, there's a couple of examples of largest deal we did, which was actually just before lockdown, on a finish and exit part complete scheme of 13.1. We're not quite there at the moment. We're probably up to about 6 mil in lending per case at the moment, but certainly hopeful that we'll get back there probably early 2021 to start looking at some of the bigger deals. You can also see in there that we actually won the Bridging and Commercial Specialist Product of the Year award this year, which was really good considering we were runners-up for the 2 years previous, so it was about time. But the finish and exit product, something I'll come on to a little bit later, but I think we're all really pleased that we got the win on that side of things as well. I mentioned we've been going 5 years. I think, as I say, there's been constant growth, continued growth throughout. I'm probably prime example of that, as Tony mentioned, sort of joining right at the start of lockdown. There probably was a few nervous nights, but actually I think that's testament to the position they got themselves in last year and the years before, that they were still able to hire staff when a lot of other businesses, lenders were struggling. So I came on in April. We also had another underwriter come on in April as well, and we've also got 3 new starters joining end of this month. New relationship manager, going to be covering sort of more the northern areas. We've got another new underwriter joining, and also a marketing assistant as well. So there's, as I say, plenty of growth. We've got a new website currently under construction as well, so really looking forward to getting that up and running with a lot of new key features and additional information on how we can help, and documentation, which obviously guys at Specialist have got as well. So really looking forward to that. And probably the biggest thing we've looked at is, during lockdown when we had quieter periods, was how we could improve the service. We've just brought on board a new online KYC document system called Nevo, which helps us effectively, very similar to some of the other fintech firms, that effectively you take a photo of the document, you scan and upload it, far quicker and far safer than emailing documents and getting them sent in the post and things like that as well. So that's really helped speed up the process from sort of formal offer right the way through to completion. So I think that's, as I say, a big part of what we did during lockdown was obviously still lend, but actually look at the ways we can increase productivity, how we can continue to work on the cases quickly and get you through on a good turnaround time. Just a bit about our funding lines as well. So we're backed by 2 institutional funding lines, which are our main go-to, but also we've got a really good pool of private lenders. So that really gives us a good broad range of the types of cases we can lend on, from your vanilla stuff right the way through to some more quirky cases that, as I say, some of those private guys are really keen to help out on as well. But also we do work with a number of mezz lenders. We will work with them directly on your behalf. You've got one point of contact. You contact Avamore for both your first charge and your mezz lending, but you will still actually get paid the proc fee on that as well. So you don't have to actually deal with it, but still don't lose out any costs that you might incur going through twice. on that side of things as well. So I think it's sort of a broad range of what we can do. I think the only other thing worth mentioning, which is across all our products, is where we can lend at the moment. So we have increased our geography a couple of months ago. We can now lend up to Manchester, Leeds, York and Harrogate, which probably sounds like a bit of a wonky line across the country, but the reason for that is rather than just drawing a line and moving it up, we're looking at each city, looking at the micro locations within that, and getting a good understanding of the liquidity in those areas, which are the good micro locations, which are more difficult. Because if we want to lend on something, we want to understand it properly and not just issue terms and then sort of get through it at underwriting stage. So you will see that increase moving forward. I think we'll probably keep that where we are for 2020, but I think early 2021 we'll see that increase further as we look into bigger areas. I think the only area that we're not lending within that sort of geography is probably Liverpool at the moment, but as I say, Manchester, Leeds, York and Harrogate is where we can lend up to at the moment. On the next slide, we've just got a few of our sort of key figures while we've been lending. There's a lot of good figures there, but for me, I think there's three key ones I would point out to you. Firstly, I think is the 92% formal terms to completion. I think it's a really great conversion from any formal offers that will complete, which I think really shows you the work that the guys put in really early on. Any of you may have dealt with us before will see that the work we put in at indicative stage is more than probably most do, certainly on bridging and development side of things. We don't want to be one of those dangle the carrot lenders, get you in and then change the details at underwriting stage. So as I say, I think we do a lot of work there, and we're also very honest. If you bring us a deal that we'll look into the GDVs and the breakdowns per unit, and if we think they're a bit off, we'll be honest. It's not one of these where let's let the valve do the work and see what happens. If we think the GDV is a bit high or maybe the build cost is a little low, we're very honest up front, and maybe sometimes to our detriment. But I think, as I say, I think that really shows why we convert so many cases from formal offer to completion. I think the next would just be really looking at the spread of business that we do. You can see down the bottom, sort of 73 bridging loans, 41 on refurbs, 15 on finish and exit, which is your part complete developments, and then 34 on ground up developments as well. So, and that's for this year. So there's a good spread there. Obviously, the bridging loans being more because you tend to be able to get them done, the turnover a little bit quicker. But I think there's a good range there, and that sort of brings me on to the final key figure for me is the 4 weeks turnaround time to completion. I think when you look at the spread of business we're doing, if we were just doing bridging loans, you'd say 4 weeks is probably not that great. But actually, with a lot of ground up deals, a lot of part complete finish and exits, and a lot of heavy refurbishment conversions as well, I think a 4 week turnaround time is a really good turnaround time. And actually on bridging loans alone, we did one back end of August in 2 days, which we will show you on the bridging products. We've also completed one yesterday in 10 days with, if I'm honest with you, a quite difficult customer to deal with. He was very laid back, and actually it was myself and the broker who tend to be the ones scrambling around for it. But 10 days as well on that. So certainly any turnaround times you need, if you've got a deadline you need to meet, we can work accordingly and as I say, get that done for you. Moving on to the first of our 4 key products, residential bridging. I think it's at the moment key to mention that it is residential bridging. We've had to put a stop on commercial lending. I think it was a decision taken probably around July time as we started coming back with better leverage, better rates. I think they've just said let's see what happens with the commercial stuff. I think I'm certainly hopeful we'll be reintroducing that next year. But I think it's very much a case of let's see where we go for the next few months, and very much focusing on the residential stuff. A brief overview, sort of loan size at the moment for residential bridging is 250,000 is our minimum loan, up to, as I say, about 6 million at the moment as max loan. I think we can consider probably 6 to 10, but very case by case basis. So I'd feel comfortable saying up to 6 mil is absolutely fine for us at the moment. And the key thing is the rate there. You've got an example there of the deal we did, but actually that rate of 0.67 is still our bridging rate. And actually that's the same rate for all types of bridging, whether that's a development exit, it's an auction purchase, below market value transaction, we're seeing quite a lot of at the moment. They will all be at 0.67. So it's not priced accordingly based on the deal. It will be 0.67 will absolutely be the rate that you will get. The proc fee has actually increased. We're actually at 1.5% now. This is a little bit of an older deal that we did. So actually, as I say, we're at 1.5% proc on all bridging again, development exit, auction purchases, anything like that as well. And we don't ever charge an exit fee on any of our bridges as well, which I think is key to note. Regardless of the type, there'll be no exit fee on there. And one thing we're seeing a bit from a lot of brokers at the moment is their own broker fees. We're actually more than happy to for brokers to charge their own broker fee. We'll collect that for them. We'll incorporate it as part of the loan, so the clients can see the breakdown. But at the same time, more than happy if anyone's charging a broker fee on top of that. And I think, as I say, probably the key areas on bridging that we've seen a lot of this year have probably been the below market value transactions. We're seeing a lot of those at the moment. And also part complete developments where you've only got probably 5-10% left of the works to be done. We can just do it on a bridge rather than a development loan. And as I say, they would both be on 0.67. Below market value transactions, we can do about 80% of purchase price now. Some may say, look, there's others out there at 90 and things like that. I think we have quite a niche area for that BMV bridge, in that it's probably worked well for the clients who don't necessarily need the 90, but the experienced guys who, experienced landlords, developers who've got the cash but want to spread their cash over multiple sites, but also still get a really good rate. The guys who are probably at 90% of purchase price and things like that are going to be on a higher rate. So I think it gives you a good trade-off of getting a strong rate as well as getting some additional out against those purchase prices on there as well. The example just down here was one, actually, we originally took it on as a development loan. It was being bought at auction. And as I say, the client on this one went on holiday for a week, was very laid back. I don't think he quite understood the time constraints of an auction. So myself and the brokers were sort of scrambling around quite a bit, trying to get it sorted. I think it got into the last week before his deadline, and we actually switched it to a bridge. As I say, did that bridge in 2 days. From sort of swap over to completion, able to acquire the site, and then we're effectively going to be swapping that onto a development facility, waiving those charges they've already paid, the 2% arrangement fee, and just getting them onto a development facility. So we've always tried to be quite flexible in working with the clients to get the outcome. The outcome at the end of the day for this was to buy the property. That was the main focus, and then, as I say, sort of convert it out post completion. So I think a good example of how we can be flexible and how we work, and also those turnaround times that we have as well. Moving on to our next product is our ground up offering on development. So probably a little different from the other products we have is we're a little bit more limited on max loan size on the ground up developments at the moment. So again, minimum loan size of 250. Max loan for ground ups at the moment is 2 million. The main reason for the difference in max loan at the moment is just funding lines. As I say, bridging, refurbishments, conversions, finish and exit has always been our bread and butter. That's the funding lines we have in place. We've had for the 5 years. That's what they tend to look to work on. We've always done a little bit of ground up, but I think lockdown has really shown us that there's a huge gap in the market there for certainly some of the smaller schemes as well. So I think we've looked at that. We've started doing a lot more on the ground up, and there's a lot of work behind the scenes with current funding lines, new funding lines to increase that. And I think that's probably the next thing we will look at again, probably early 2021, will be increasing the offering we can do on the ground up, so we can start looking at some bigger cases. But at the same time, as I say, I think we've got a good niche there that actually will look at a lot of the smaller developments that probably a lot of other lenders won't consider. So sort of 250 to 2 mil. And again, you can see the rate there we did on this one of 0.67, so 8% a year. I would say there's a range on the ground up stuff of probably 8% to 9.5%. That's very much dependent on experience. We can be quite flexible on the experience for the ground up stuff. I would say, someone who's got no experience whatsoever and wants to do it themselves, a self-build, that's something we would struggle with. But if you've got someone who's lacking in experience, but they've got a good contractor on site or a good project manager, then absolutely we can still consider that. So I think that's important to note. But as I say, I think, strong rates for development finance, certainly in 2020, where we are at the moment. So as I say, I think that's been really key. And as I say, I think any smaller stuff you're looking at, we can absolutely help on that side of things as well. We're pretty flexible on the term, normally sort of 12 months, but we can go up to 18 on the ground up deals as well. And again, a similar sort of transaction again, where, as I say, they completed on the deal. It was effectively a demolish of this building here, and then complete ground up construction of 1, 2 and 3 bed flats. I think the key with this one was actually the turnaround time. I haven't noted it on here, but actually the turnaround time on this one, I think we got it done just over 4 weeks. I think it was about 4.5 weeks to completion, which, as I say, on a demolish and ground up deal was pretty good, to be fair. So that's certainly an area we're moving into. And as I say, I think it's watch this space for the ground up for 2021. And the next two are probably our core products. This is really what we pride ourselves on, is our refurb and conversion products. We can cover anything from light to heavy. There is no limit on the build cost to current value. We're not limited at 100% or anything like that. Anything 100 plus is still classed as heavy. And I think we're being really strong on the rates at the moment on what we can offer, both on light, medium and heavy refurbishments and conversions. So on light, you would be 0.71%, heavy up to 0.73. So you can see the range there of minimal works right the way through to pretty extensive works. There's a close range on the rates as well, to be fair. Again, minimum loan size of 250,000, maximum loan size up to 6 mil at the moment. They've actually got the max loan to GDVs back to front. So for light, it is 70% loan to GDV and 65 for heavy. It would also be 70% for medium as well, medium plus. The key, I think, again, plus the rates, is where we can get to on day one now. So we can do 70% net plus fees day one, which is a really strong offering. On top of that, obviously, all the build costs. And again, that would be 70% day one plus net plus fees on light, medium and heavy. There's no reduction across the board. All would come with a 2% arrangement fee, 1.5% proc fee for light and medium, 1% for heavy. And again, the exit fee, we would only ever charge an exit fee on a heavy refurbishment. So one that is 75% plus build cost to current market value. So that's where we would sit there. And as I say, I think that the key really for us on this is the rates and the leverage we can get to is very strong in the market at the moment. There's not a huge amount out there looking at the heavy, which is, as I say, something we're seeing a lot of, certainly in the last few months, but throughout 2020, to be honest with you. And again, I think the leverage they can get day one is really important on these. The figure probably to be careful of on some of the lighter deals is the loan to cost. So figure we're not shown there, but I would say sort of 90 as a maximum loan to cost. Ideally 85, but we can push that up to 90% if need be. You don't tend to have too much of an issue with those with the heavier deals, but as I say, with the lighter stuff, that's just a figure to be careful of as well. And the example here was actually just an office block PD conversion, which again is probably the key one we see on the refurbishment conversion products. 50 units. They added an extra floor onto there. And as I say, we provided the initial bridge of 2.7 purchase, and then obviously funded the full build costs. I think this one had a bit of a tricky company structure, which again, the underwriters worked with the guys to understand that. And I would say on that point, the underwriters are very much looking for solutions, not reasons why not to do deals. And you have access to everyone throughout the process, whether that's myself, the relationship managers, the analysts who will review the deal up front, the underwriters who will review the deal through to completion. They're all more than happy to pick up the phone and speak to you on things, which I think is really important in this day and age, especially with a lot of us working from home, having multiple points of contact, I think is really important. Onto our final product, which is really our flagship product, which is our finish and exit. Again, this is the product that we won the Bridging Commercial Specialist Product of the Year award this year. As I say, it really is a truly unique product available. I think a few lenders have tried it, and probably unsuccessfully, but effectively what it is it allows us to step into part complete projects, which, as you can imagine, this year especially has been very popular. We've seen effectively very early stage, and I think the key with this is that it's not just a dev exit with minimal works to be done. We can step in at foundation stage, wind and water type stage, refi the current lender who's been lending on it, fund the remaining build costs, and also actually provide plenty of time for them to exit via sale or refinance. And also sometimes you can have a pre-agreed equity release on it, very much like a dev exit. Once the building's been completed, we can then work off the GDV and release some more cash for them to actually move on to their next project before they've sold this one. So it really is dual funding, really. It's development finance with the dev exit all as part of one deal. And as I said, there's no one really out there at the moment who's really that keen to step into part complete projects, which, for us, I think a lot of people think it's because there's something wrong with the project, but actually this year's been prime example of actually most of the time it has been just timescales, getting workers on site, lenders not funding further drawdowns or pulling funds. So actually, this scheme, for example, was a fantastic scheme that we looked at. I went out to the site myself, an old office block being converted into flats. The developer had wealth of experience. He'd done loads of projects like this before. Current lender had just said, we're not willing to fund the remainder. He'd been putting a load of his own cash into the deal to keep it going during lockdown, to the point where I think he had to sell he was going to have to sell his truck if we hadn't stepped in. So, he was really at the point where all cash flow had been dried up due to lockdown. We stepped in, we refinanced the current lender. I think it was about 1.6 million we did day one, provided the remaining build cost, which took us up to, I think it was about $500,000. And then, as I say, that sort of finished that off, got it out. And as I say, I think he's nearing completion of the project now, looking to refinance onto a term deal and looking at the next projects available. So as I say, I think that's a really key, not just for this year. It was a very popular deal previous years, but especially this year. We're seeing a lot of people looking to buy these projects now as well, whereas before it was very much the current developer coming to you and saying, right, I need to refinance current lenders. We're seeing a lot of experienced developers now buying these sites off of people, taking them on and finishing them off. So as I say, if you've got any clients who are looking at anything like that, certainly it's something we can help with. So that really is our four core products. As I say, obviously with regards to documents and help, obviously the guys at Specialists, I worked with them a long time at HDB and now with Avamore, I'm sure can help with anything you need, but we're very simple. There's no forms to fill. It's very much an email to the guys at Specialists. They will pass on the details and we can get indicative terms back to you pretty quickly. So that really is our four keys. So over to you, Tony.
Yeah, thank you very much indeed. We haven't got any questions coming up, so we are just about bang on time, which is brilliant. So I've got a couple of questions. Again, these are quite long questions. I have to look on my screen because they've not actually come out on the spreadsheet I've been given. So bear with me 1 second. How does Avamore's process differ and what benefit does that bring to the client?
Yeah, I think I mentioned it briefly earlier in terms of our 92% conversion. I think we do a lot of work up front compared to a lot of others. And I think that just shows the honesty that we do. And as I say, the work that we've done up front actually means that you get an offer from us, even an indicative offer, you're confident that we can proceed with that. As I say, we're never going to be that lender that dangles the carrot and tries to get your business in and then change the goalposts further on down the line when you've got the clients buying. I think, as I say, the work the analysts, the underwriters do at an initial stage, I think that's where we really differ ourselves from. And as I say, I think honest lending is very much a tagline I would use for Avamore.
Okay. Next question we've got is, where are we? What have you done to ensure that you are as competitive as possible in a post-COVID market, if there is such a thing?
Yeah, absolutely. Well, yeah, as and when that may come. But I think that we certainly were a lot quieter during initial lockdown than we would have liked, I'm sure, like most. So we spent a lot of time doing a lot of introspection in what we can improve with regards to our service standards, the journey for the broker and the client throughout. I think we've worked a lot on, as I say, we're working on a new website. We've got the new KYC system on board as well, helping to smooth things through. And I think also, with regards to just online systems in general, I think we're all in this mindset that now if there is a second lockdown, we're all a lot better prepared for that. So I think we've spent a lot of time trying to streamline the process for brokers and clients.
Final question. Do you have any, this is where you have to get your crystal ball out, unfortunately. Do you have any safeguarding contingency plans in place if a second lockdown happens, either for ongoing or completed cases? Yeah,
absolutely. I think we're in constant contact with all of our funding lines, certainly the two institutional ones. We will have at least 2 calls a week every week with them just to update on what their thoughts are, what their feelings are. But I think from the conversations we've had in the last couple of weeks with them, they're a lot more confident in terms of if we do go into a second lockdown, but being able to maintain the current leverages, the current rates. I think they've got a much better understanding of where we probably will look like in March, April time next year. But I think actually, if you look at the first lockdown, we were very good with our existing customers. Anyone who was coming to the end of their term and had difficulties finishing off, we provided 2 or 3 month extensions for free. I think we'll continue to do that right throughout any potential second lockdown and things like that as well. So we've always tried to work with clients, whether that be extensions or with some of the development stuff, switching them onto a dev exit fee free and giving them another 6-12 months to finish it off. So yeah, we've always been working with the client's best interests at heart.
Excellent, Adam. Thank you very much indeed. There's no questions from any delegates, so we will love you and leave you, and we'll probably speak to you later. So.